We're in San Francisco, California at EnerCom's the Oil and Services Conference. Joining me now is Don Klapko, President and CEO of Equal Energy. Good morning, Don.
Good morning. How are you today?
I'm great, thank you. Now, you have announced intentions to review the composition of your board, given your company's pure play focus on Oklahoma. Talk about any developments investors might expect in terms of board composition moving forward.
Right. What we have is, like you suggested, a pure play in Oklahoma. Our vision is to get more board representation from the U.S. Our nomination and governance committee has been working hard, and we've identified a great group of individuals that are considering joining our board. And our target is about 3 new board members from the U.S., specifically, hopefully, in the with mid-con experience in the U.S. And so we're quite excited for these potential 3 new members to join us, and they will be on our proxy circular and be part of the AGM and be voted in at that time in May.
Okay. And in recent years, you have been the only public company engaged in Hunton development drilling in Oklahoma.
Yes.
Can you give us an update on the state of the play from Equal's perspective?
Well, in Oklahoma, we are and have been up until just very recently the only publicly traded company in the Oklahoma play. Now, again, just a quick review. The Hunton play is a liquids-rich gas play that we've got a tremendous experience and track record in this play. We've drilled over 70 wells. It's a high success rate play, over 95% success, low decline production play, and we've become experts in this play. And but you know what? Because we are the only ones that were publicly traded, it was more challenging to get the story out. Just recently, we have a smaller entity, about 3,500 barrels equivalent a day versus our 6,700 barrels equivalent, that have just gone public with a limited partnership in the last couple of weeks. So this will give our shareholders another entity to look at and to compare us to. And as far as I'm concerned, this is great news for Equal Energy because it doubles the amount of exposure to a public market for our style of play.
Now, you recently indicated Equal will drill 10 Hunton wells this year.
Yes.
Can you help investors understand how you came up with this drill plan in terms of production versus reserve replacement?
Right. Well, 10 wells is very fundamental to us. 10 wells is one rig running continuously throughout the year. 10 wells pretty much matches our cash flow for the year based on our assumptions of pricing on commodity pricing. So with a 10 well program, we are a balance of growth and dividend company, and we can show positive direction in both. In fact, when you add the two together, we're going to be pretty much a double-digit company when you take into account the growth and the dividend. So this is the style of company we're looking for. It's a balanced approach of growth and dividend.
How would you respond to investors who might question the decision to drill 10 wells to, say, for example, drill 5 wells and increase the dividend you pay?
Okay, so that's a very interesting question. In a scenario such as this, a 10-well program will increase the reserves by 1.6 times whatever we produce, and will show 2 to 4% growth this year. If we were to cut back our drilling to 8 wells, we would have flat production and increase our reserves by 1.3 times what we produced. And if we dropped our drilling down to 6 wells, we would replace our reserves. So to go down to 5 would be sort of an unacceptable step because you're in a situation where you're not replacing your reserves, you're not maintaining your production, and for sure not growing your production. And the neat part about our company is we operate and control all our drilling at a very high working interest. So in the case of the situation, if the commodity prices fall back for some reason, we can adjust our drilling program, take out a well, and maintain our pristine balance sheet and not get our debt to cash flow over 1 time. So that's just about unheard of for a liquid-rich gas producer in this industry to have that gold-plated balance sheet like we have. And our vision is to protect that balance sheet, protect the dividend that we've established. We don't want to backtrack on that. We want to maintain that dividend going forward, and then the third priority is the growth.
Speaking about growth from the standpoint of potential acquisitions, many executives indicate they will only pursue accretive acquisitions. How are you looking at acquisitions at this time?
Well, acquisitions, where our trading metrics are, the key word is accretive. We have to be accretive in these acquisitions. And so what does that mean for us? That means small bolt-on, if you will, use the word bolt-on acquisitions in and around our existing play. So if we can find 2 or 3 sections here or there that augment our land position and where we're drilling, we will undertake those type of acquisitions that are accretive under the metrics that we're trading at right now. I would say that these acquisitions would also have to fall within our capital program this year so that we are continually watching and protecting our balance sheet.
What are the top priorities for management as you look at your plans for 2013 and beyond?
Right. Well, there's about 3 main categories that I think of as we work through 2013. The first one is to complete our transition. We were on both sides of the border with production. We've sold our Canadian assets off. We are now reestablishing our leadership team in Oklahoma City. So we've just hired a new gentleman by the name of Scott Smalling as our CFO. All our financial reporting is moving down to Oklahoma City from Canada, and our key team members we're looking to add on to because some of these players have left us as they're staying in Canada. The other thing we're doing is to complete the transition of reconstituting our board with more U.S. board members. As I said earlier, we want 3 new board members with U.S. and hopefully mid-con experience to help us move into the future. So you start thinking in terms of Equal Energy as a U.S. company, U.S. domestic filer as of January 1st, 2013. It's a U.S. company that reports, looks, walks, talks like a duck. It is a duck, and it's a U.S. company now. The third thing is we have a really good geological team in the U.S. that continues to enhance our mapping and our existing Hunton play, look outside of our Hunton play for these accretive acquisitions, and monitor new opportunities within our playing field in the general area of where we're operating. So we're not going to take off somewhere like Montana or something. We're going to stick within the general Oklahoma area and look for new plays and opportunities. So those are the 3 things. Right now, just to give you a feel, we have a 5-year runway of inventory just on the Hunton play alone. So we have over 50 locations, 1 rig running for 5 years, and they continue to have many more drilling opportunities than that. There's hundreds of potential Hunton locations that we simply just don't own the land on at this moment in time. So it's a really, really positive story, Equal Energy. We're really excited. Our balance sheet's in great shape. We've got the drilling inventory, we're drilling, and we got the excitement of developing a new team and board membership in the U.S. here. So,
well, Don, best of luck to you in 2013 and beyond.
Thank you very much.
Don Klapko with Equal Energy.